Ladies and gentlemen, good day and welcome to Q2 H1 FY'25 earnings conference call hosted by Karnataka Bank. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sri Krishnan H., MD and CEO from Karnataka Bank. Thank you, and over to you, sir.
Thank you, Del. And good evening, everyone. Warm welcome to our Q2 FY'25 earnings call. On behalf of Karnataka Bank, I'm Sri Krishnan, MD CEO. I have with me here Shekhar Rao, who is Executive Director, Abhishek Bagchi, who is our CFO, Vinay Bhatt, who is our Chief Compliance Officer, and Raghuram, who is our Chief Risk Officer. So in addition to that, we have a couple of other executives who are from the Investor Relationship team. Greetings for the festive season, and wish you all and your families a very happy Diwali in advance. The bank has ensured that we are fully prepared to capitalize on the opportunities that are coming up due to the festive season during the second half of this year. As I have mentioned during the previous earnings call, the bank has been undergoing major restructuring and transformation process. So during the quarter, a couple of updates. We have brought in a new leadership for Head of Retail, MSME, SME Agri Assets, that is Srinivas, and Head of Liabilities plus Third-Party Sales to focus on the business growth, that is Venkat M. Both of them come with very rich experience and banking as well as sales experience. And besides this, we also brought in a new Head of Retail Collections, Ram Subramaniam, to ensure that maintenance of our portfolio health on the retail side. With this addition, I wish to also confirm that all the senior restructuring and the leadership is now in place. We have the Karnataka Bank veteran leaders who are also participating very, very actively and wholeheartedly in our transformation journey. The major transformation processes that are underway are credit transformation, a national back office, where we have made substantial progress by centralizing clearing, and we will also centralize treasury operations in a couple of weeks. And we have created the sales and the product organization, both for retail assets, mid-corporate and corporate business, and also the retail deposits and CASA accretion. And we do have them attached to various locations. We are, as you are aware, 22 states and 2 union territories, and most of the regions are covered. So all these organizations are rapidly progressing, and we really hope to see some benefits in the same during the upcoming quarters. To support this growth, we also have enhanced our tech infra and operational capability. All the enhancements are in place, and we have done some major enhancements both in terms of our storage, processing, and also a lot of other functional features in our overall tech stack. We have seen some improvement and a significant improvement in the book quality, which will improve even further as we go into the future quarters. During the Q2, we have taken a conscious decision to focus on portfolio quality over growth, and during Q2 '25, and we will continue to maintain that focus on critical parameters. Basically, we define our bank's performance on growth in advances, deposits, improvement in quality of advances book, profitability and NIM, and favorable ROE and ROA. These are the critical metrics that we will be working towards. In the past few quarters, we have been focusing on growth, but we took a pause during this quarter to focus on quality as well as profitable growth. And we believe that the numbers are speaking for itself based on this strategy, which is a short term. But we will accelerate the rest of the other defined parameters and metrics as we go forward, because all the engines which is related to the retail business, the corporate business and so on have all started kicking in. I will be talking about it as part of the commentary. Overall aggregate business, the business turnover of the bank stood at 1,75,284 crores, up 12% on a year-on-year basis, against 1,56,468 crores in September of 23, the corresponding quarter last year. On the profit after tax, For Q2 FY'25, the current quarter, it was 336.07 crores as against 330.26 crores in the corresponding quarter previous year. The PAT for the half year stood at 736.4 crores versus 700.96 crores as part of the H1 of the last year, an increase of about 5%. The same was 400.33 crores. That had, the previous quarter, that had a one-time interest refund, IT refund of 81 crores. So which effectively means that from 320 odd crores, we have moved towards 336 crores this quarter on a quarter-on-quarter basis. Due to the accounting policy changes, I think we called it out the last time also, on investments and available for sale, the AFS portfolio, we have classified effective April 1. There's a credit line in our AFS reserve and the opening revenue reserve to the extent of about 106 crores and also about 24 crores respectively. Had the bank continued the earlier accounting policy, the income on investments and the other income which would have been higher, the profit before tax would have been higher by about approximately 71 crores. But that is something that is possible to really recognize only if there is a sale in the securities that we are holding in AFS book. And this is something which is common across all the banks due to the revised RBI regulations. But this on a comparative basis, previous year and corresponding quarter, there is a difference, and which is why I am also stating this number. As far as the gross advances book, the total of the advances remained at 75,306 crores as of September 24, and this reflects a year-on-year growth of about 12.5%. The industry growth for the same corresponding year-on-year was about 13%. So we are very much in the same trajectory as far as the industry is concerned on the gross advances. Our overall strategy was to grow retail, agri and mid-market RAM, and where the growth has been led by retail, housing and gold loan for us, with a net book acquisition of about 3,691 crores on a year-on-year basis in the segment. The bank has also committed earlier that we will reduce our exposure to large mid-corporates that were opportunistic to deploy for short-term better yields than our treasury deployment. The bank also took a conscious decision in this quarter not to go for this low-yield bulk PSU advances which would have locked us up for a couple of years at very low rates. And because of the interest rate and outlook which has been there in the next few quarters, we didn't want to get committed, which is also one of the reasons that the advances book has not grown. But in terms of quality and the churn, this is something that we have ensured during this quarter also. With our new heads of businesses for retail and corporate that I had mentioned earlier, and their respective regional structures are in place or are also in place now, the focus on acquisitions from these segments will increase going forward. On a year-on-year basis, retail advances have grown by 12.2%. And this is something which is very, very good from our perspective, because the yield is also something going forward will be beneficial for us. Let me move to the aggregate deposits. The deposit number stands at 99,967.99 crores, reflecting a year-on-year growth of 11.66% over September 23. And the industry growth, again here, among scheduled commercial banks is about 12%. So we are very much in line with the industry growth. Our CASA deposits stood at about 30.82%, up 28 bps from the 30.54% in June 24, but lower than the last year. And I don't have to really elaborate much on the industry phenomenon which is happening on CASA or liabilities. The CASA as an overall deposit of scheduled commercial bank has declined about 43.66% in March 22 to 39% in March 24. So even during the Q4 of the last year, as per published numbers, the CASA dipped by about 271 bps. That's 2.71%. And this trend is also continued in September. Liquidity reasons and other banks offering high lucrative rates for 1 year short term, the deposits that were reflecting a lower number, as again confirmed by the Reserve Bank of India statistics and various news that have been coming out on this subject. There is a flight that is moving away from CASA into term deposits and into other instruments outside of banking system as well. But we believe that our bank is well positioned for Q3 because of the agricultural harvest season and the expectation of RBI easing up on rates, and we expect that the CASA will continue as far as our growth is concerned. During the quarter, we shifted the growth to the CASA book and retail deposits to replace lower yielding bulk deposits. As a policy, we did not bid for much of this higher bulk deposits at very, very low rates, and the market was not really rational at some point of time, we felt, because it just did not suit our book. So which is why probably you're not seeing a growth in the book, but in terms of quality, we have improved because there is a substantial reduction in the overall bulk deposit as a percentage. So I wish to confirm to you that 92% of our liability book comprises of retail liabilities, and only about 8% is in the form of bulk deposits, and these are also at our card rate or favorable rate. We have not been really chasing deposits based on very, very low rates, very, very high rates as far as the market is concerned. Going forward, we have a set of new products that are being launched in this quarter and the next quarter. I'll be calling out, and because most of these are focused on liabilities and increase in deposits and also in retail loans. A couple of examples: we are launching KBL Genius, which is a student savings account; KBL Peak, which is an education loan; a premium savings account; a merchant payment app, which will be QR code based; and also enhancing our Mobile Plus and Mobile One applications for pre-approved personal loans, and also launching for specific medical equipment loans and a wealth management advisory platform, which will be integrated with our app in terms of the access and functional features. In the last quarter of this year, we would be launching a supply chain financing program, exclusive women's savings account, flexi recurring deposit RD scheme, and also a family banking program whereby all of the family members in the will be part of one group account, and we will be offering basically benefits across the family members as one unit. And last but not the least, we are also working towards developing a MSME super app, which will basically capture the life cycle of our MSME customers, right from the Udyan registration and renewals and GST and their entire working capital cycle, as well as the payment of taxes and so on. So basically what we are trying to do is to provide digital access to this community, which is huge for our bank and will definitely act as a center of growth for the bank in terms of the overall assets and also the promoters' business from their personal relationship. The NII for H1 FY'25 was 1736.92 crores. It was up 6.1% on a year-on-year in comparison. The NIM, we have clocked at 3.38% for the half year. There has been a dip in Q2, but overall we still have done better, and we are still within the guidance for 3.4 to 3.6, and we are about 3.38. There's a minor reduction, but we will definitely make it up as we increase our retail advances acquisition and also direct to customer acquisition on the corporate book. The loan yield, with the slippages being under control, NPAs coming under control, the bank is definitely increasing the focus on loan yield and improve the overall profitability. Bulk opportunistic advances will be replaced by direct to corporate advances and retail advances, and we will still show a growth in the book, but also a churn in the book, which will be more swinging towards the higher yielding advances. This is something which we believe that the necessary infrastructure, the people, the technology, products, and benchmarking in terms of turnaround times have all been done, and we are ready to go on this. Likewise, a combination of this various products between Q2 and Q3 into high-yielding segments such as mortgage, vehicle loans, and education loans, etc., we definitely expect that the overall yield will improve progressively over the next quarters. Our CD ratio is still at 75.34%, continuously improving every quarter, but we still have a headroom there, and we believe that our ambition to grow the overall advances book with our capital and our CD ratio and our deposit acquisition engine, which will definitely show much better results as we go forward. We believe that we still have a lot of headroom here. On the stressed assets, this is one area where we will be very proud in this quarter because the gross NPA has significantly improved from 3.54% to 3.21%. And this is something that we had committed in the last few quarters to say that we will come closer to 3%. And I think we are well on track as far as this is concerned. Just for reference, the same was 3.47% in September of 23. So this again reflects that over the last 1 year we've been moving very well. On the net NPA, similarly, there's a significant improvement to 1.46%, down 20 bits from 1.66% as of the last quarter, and about 1.36% as of last year, September 23. So this again reflects and well on target for our commitment that we will move this closer to the 1% range in the following quarters. And I believe that with our significant recovery and reduction, not much of additions into our overall NPA book, we believe that we are on the right track. This has been achieved because the gross slippages has come down drastically, and we are at 0.33% in Q2 as against 0.59% in Q1 and as against 0.52% in Q2 of last year. For the 6 months ended September 24, the half year H1, the slippage ratio stands at 0.94% as against 1.03% in 6 months. Here again, this has been fully through recoveries for the quarter. Excluding the upgraded accounts, we have had a recovery of about 148.01 crores versus 133 crores in Q1 and as against 117.82 crores in Q2. There is also some more good news on the standard restructured advances. Without related accounts, the restructured book has come down to 1,051 crores compared to 1,160 crores as of 30th June and as against 1,338 crores as of 31st March 24. So the significant metric that we actually measure is a combination, and this is published in our investor PPT also, where we normally combine the gross NPA plus restructured book as a percentage of our gross advances. And I am actually happy to report that as of September 24, our percentage has come down to 4.89% as against 5.39% in the previous quarter and as against 6.78% in the previous year, the same quarter. So as a result of this, our PCR, which is including technical write-off, has crossed 80% and as against 78% in June. And it was a little higher last year, but of course, post that we have had a lot of events that happened, including the expiry of the COVID moratorium period, etc. So the entire restructured book is now completed its term as far as the COVID-1 and COVID-2 regulations are concerned. Our LCR, as all of you are aware, Reserve Bank of India, based on a study that they have done across all banks, and because of certain, I would say, inconsistencies that they had observed among many banks, they have come out with a revised draft guideline, which actually is to be implemented only from April of next year. But as a conservative mechanism, we at Karnataka Bank have tested the LCR based on the revised guidelines. So even after the revised guidelines, as of September 30th, we stand at 143.93% on the LCR, which is very comfortable and as against the statutory target of 100%. As far as the cost of funds is concerned, despite the market volatility, we have remained stable at 5.58%, and it was the same number almost for the Q1. And the cost of funds for the entire half year was about 5.42%. and comparing to the half year last year, it was 5.36%. So overall, because of our strategy not to chase high cost deposits, we have been extremely guarded on that, and we believe that it has remained stable. There is one other good part which we need to report, which is credit cost. Our credit cost for the Q2 was at 0.09%, which is actually the lowest that we have had so far, compared to 0.11% in the previous quarter, and as against 0.17% in the quarter 2 of last year. The total credit cost for the half year stood at 0.2%. That's like 0.11 plus the 0.09 that I talked about. This continued reduction was a result of significant lower slippages, and we believe that the same trend will continue as we go forward. One of the areas of concern for us is the cost to income. We have incurred extra as far as elevated one-time costs in technology, some lateral recruitment, and also increased provision for superannuation benefits because of the fact that the rates have moved and the rates have decreased as far as the superannuation benefits of our staff, the actuarial calculations. Based on all this, there is an increase, but we believe that we will be able to control this through rationalization of costs, through also increase in income, and making sure that we are back to the mid-50s and then, of course, reducing it to closer to 50 in the following quarters. Our commitment earlier also was that we will commit to bring it down to about closer to 50% by the end of this year. I think we might take a little 1 or 2 more quarters more, but all the cost rationalization exercises initiated across the bank to negotiate with all the vendors and rentals and IT, non-IT expenses, and also not consciously going in for some expenses going forward. We believe that we are on the right track as far as our overall earnings is concerned. Because of this, the ROA has come to about 1.13% for Q2, and as again 1.19%. Our guidance has been 1.2. I think that we will get back to the 1.2 to 1.25 in the following quarters, and we have reasons to support this. The ROE has dipped to 11.63% compared to the earlier quarters, and this again is because of the additional equity that we have raised, which all of you are aware. Our CRAR without the half yearly profit being folded into the reserve stands at 17.48%. If we add that, it would be more than 18.5%. So we are very comfortable both on tier 1 and tier 2. And in comparison to the last quarter, we were at 17.64%, so which is not much of a change at all. And as of last year, of course, it was much lower. And because of the capital raise that we did completed between September to March of 24, September 23 to March of 24, we have been quite all right on this front. So on this note, I would like to end our commentary from our side, and I would request Dale to go ahead and for all the calls. I would like to also make sure that we will try to answer all the questions, and in case that there are some questions that we might need some time, we will either respond by mail, and I have my investor relations team comprising of Soham and the E&Y team to get back to you. So over to you, Del, for the Q&A.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Agastya Dave from CAO Capital. Please go ahead.
Hello, am I audible?
Yes, Mr. Dave, good evening.
Good evening, sir. Thank you very much for the opportunity, sir, and I must congratulate you for your work on the NPA side. It seems pretty promising. Sir, I have 2 questions, both of them related to the first slide that you have added in your presentation today. you have mentioned certain corrections in the low-yield bulk deposits, PSU advances, and also on the high-cost deposit side. So the first question is, can you quantify what was the impact of this entire exercise? Is it over completely, or will we see impact in the coming quarter as well? And the second question, again related to the same statement in the same slide, you mentioned that we are going through a transitory period, which I understand, sir. Can you put a particular timeline on when do we see improvements, incremental improvements happening in the NIMs on the growth side, and when do you see the retail engine firing fully for you? These are my questions, sir. Thank you.
Sure. Thank you, Mr. Javed. Both are relevant questions. So one is that, in the last 3 to 4 quarters, we've been growing the book on account of the opportunities that we had, because we did have very low CD ratios in the past, and we had excess liquidity that we were deploying into treasury. So as a first step, as a strategy, and this is very tactical, we had moved to clearly line of credit and also some kind of a short-term credit, loans to PSUs and a couple of other large corporates, which were yielding and more or less on EBLR range, EBLR plus something. And this was not long-term also. So this was short-term deployed because our earnings, we had to take care. And that is a process that is getting replaced by one, retail growth. So the last quarter and this quarter, our retail net acquisition was about 1,250 crores. And this quarter also, we have clocked more than 1,300 crores. Now with our DSA structure in place, corporate DSA structure in place, we would be in a better way where we will be able to increase this run rate. And in the following 2 quarters, we believe that we will be much higher than the current run rate. So that is one. The second part is that we have recruited in the last quarter itself new head of corporate and wholesale banking business, where we were not really pitching for relationship-based banking for corporates. And this is something where we have now got a zonal structure where we are covering all the 4 regions, and through this national leadership, we are able to pitch not just for loans, but also some products, which are, essentially some liability-based products like payroll processing or something related to non-funded business or forex and trade finance business. So this cross-sell penetration plus the lending side would have much better yield as far as the bank is concerned, because not only the rates are favorable, but also the fact that we get other business to increase our other income. So this is the process whereby we do have pipeline which is healthy, and as much as we grow the retail, a similar number would come from the mid-sized corporate and the large corporate business, which is direct to corporate business. So what we are doing is basically the large corporate business, which was at a EBLR plus very minimal higher premium that we used to have for this large PSU advances, etc. We are replacing, and this will be a gradual process which will take at least the next 3 to 4 quarters. But it will start reflecting from Q3 onwards. That is one. The second question is that the NIM, would it have an impact? Yes, it will have an impact, because if for a moment I say that between the retail book and our mid-corporate and large corporate book, direct to corporate lending, if we are able to grow the business by about 4,000 to 5,000 crores every quarter, then that amount would actually fetch on a book size of 75,000 crore, and you can do the math there, where there will be a yield kicker of at least about 70 to 90 bits. And if that happens, then our overall NIM will have a positive impact. And this is the strategy that we had articulated in the last quarter and the previous quarter, but it has taken time for us, and we will ensure that we are executing this without any loss in focus. And we believe that in the next about 3 to 4 quarters, this will start yielding better results for us with our focus on RAM. Our NII will go. But again, I don't have to tell you that this is all a journey. And this journey is something that we have now started. In the last about a year and a half, we have now got all the senior management, the new and the old, everyone into one unit, and we got them in place. We now have the operations and technology capacity. We now have the processes on turnaround times, as well as credit process evaluations, etc., done on a very, very rigorous basis with very stricter on the TAT. And last but not the least, there are very clear products and new technologies that we have been putting into place, including CRMs, etc. So all of this will start yielding results both in the retail as well as in the corporate side of the business. So I hope I've answered your question, Mr. Dar.
You have answered so very nicely. Thank you very much for your time and patience. Thank you very much. All the best.
Thank you.
Thank you. Next question is from the line of Yash Dantewadia from Dante Equity. Please go ahead.
Hi, am I audible?
Yes, Mr. Yash, go on.
Yeah, I just have a couple of questions, especially regarding why is the employee cost up 30 crore quarter-on-quarter and other expenses 20 crore quarter-on-quarter. The employee cost is up quite significantly. Could you explain? Is this the one-off?
So there are, between the last quarter and this quarter, let me explain, and including in March. So in March, again, this is a residual effect, but it will taper off as we go forward. In March, as you are aware, the IBA settlement that happened, where almost like, I would say, 85% of our staff are covered by IBA scales, and whereby the IBA revised the whole pay scale to about 17%, and we had an arrears, and we had a provision earlier made for 15%, and this was made to 17% in the final settlement. And we had made that also between the December and March quarters, and we had completed the payment in April. However, in March of this year, which is the year end, we had to do an actuarial calculation because there were leave encashment, pension, and a couple of other benefits where the changes happened as far as the overall process in terms of the structure due to the IBA settlement. Also, salary increase and also the pension part. So as a result of all this, we had to make a 162 crore provision on our total employee expenses as of March. Now thereafter, the superannuation benefits, we need to do a quarter-on-quarter actuarial valuation, and as of June, the actuarial valuation was 34 crores, but as of September, it is 55 crores. So that itself is about 21 crores. In addition to that, we have also, as you are aware, done some lateral recruitments, and which is also the other reason. So there is about 10 crores or so increase as far as our overall salary wages is concerned. So overall on the establishment, I would say that there is an increase of approximately, give or take about 30 crores. 390 has become 349. And we believe that it will stabilize at this level. And if interest rates are favorable as we go forward and not much of volatility, the actuarial valuation, any reversals, etc., will not happen. So that gives you a fair sense of what we are doing as far as our employee costs.
And also the other expenses, are we putting in new branches?
Yes, we are doing that. It's not as if we are expanding by the dozen, but yes, in the next last quarter, 2 quarters, we have added about 10 odd branches, including some shifting of branches, and also we have set up a national back office in Mangalore. We also got centenary building which has been set up in Mangalore, so the depreciation and the maintenance, etc., have gone up. But all this will yield results because we have just shifted our national clearing into Mangalore. We are shifting our treasury back office as the next step, and our treasury GCP from Mumbai into Mangalore. So Mangalore will become the national back office for other areas also as we go forward. So as of now also centralized account opening. So we basically what we are doing is that we are decluttering our branches and moving a lot of operational processes from branches into the centralized site so that the branches can focus on sales and service.
Right. Also, one more last question. Based on the loan book, would you be able to share the unsecured and secured mix? And are you making a change to your guidance? You, I think, guided for a advances growth of close to 18%. So would you revise that, and also the unsecured secured mix?
The unsecured and secured mix has always been 90% fully collateralized book for us, and that continues. There is no change to that. The balance 10% also has been more to large corporates, PSU, etc. So technically, we do not have any unsecured retail exposure per se, other than some co-lending and a couple of other, arrangements that we have. But there, the total book has not even crossed about 200 to 250 crores. So I don't think that anything significant is there as far as our unsecured is concerned.
So agri is gold backed, most of it is what you're saying?
Agri is gold and land backed, both. We do have both. So
90% of your book is secured, right?
Yeah, 90% includes the agri book, which is also secured because we either have commodity as a asset collateral, or whether it is land from the agriculturist, or it is gold, one of the three.
Right. And the advances, please.
On the advances, what was your question? Yes?
I'm saying you've guided for 18% gross advances growth. Are you going to revise that downward?
So I think, we will grow probably about, in the next 2 quarters at about 15%, and then grow to the 18%, because this is a transitionary phase where we were growing with some bulk advances in the past, but the bulk has come down drastically. And obviously, we are now doing this mid-size corporate where the ticket size is about 30-40 crores, and then large corporate, which is about 200 to 50 crores, etc., but all supported by other products, and the retail book. So there will be a 50-50 mix, which will continue. So overall, what it will mean is that we will be, let's say, if the market is growing at about 12-13%, we will definitely be ahead of the market by the year end, despite this more or less flat position as of this quarter. But the earlier quarters and the earlier year, we grew at about 18-19%. So we will definitely be ahead of the market, but may not be 18-19%, but anywhere, let's say, between 15-18%.
15 to 18%. And also, I just want to understand one last thing from you. On the gross advances front, you said 90% of the book is secured. Just confirming that MSME, that includes the entire book, right? Your total book is, you're telling me that 90% of the book is secured assets.
Yes, sir. Other than the ones which are NBFC lending, which is about 18% of our overall book. So the NBFC book is through corporate guarantees and collaterals from the company's receivables.
But what rating are these NBFCs? Like, what is the rating?
All AAA, top notch, and also a couple of them who are AA.
None of these fintech, new fintech companies, sort of companies, right? Just want to confirm that.
No, we do not have that.
Right. Perfect. I'll just come in line. I just want the ROE guidance, but I come in line.
Thank you, Yash.
Yeah, thank you so much.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants, please limit yourselves to 2 questions per participant and come back in the queue for follow-up questions. The next question is from the line of Saket Kapoor from Kapoor & Co. Please go ahead.
Yeah, namaskar sir, and thank you for the opportunity. Firstly, sir, on the cost to income part, we are at 58% for this quarter. So, taking into account this transition period which you have articulated, where are we going to settle in terms of this H2, and what's our longer term outlook on the same?
See, fundamentally, Mr. Kapoor, we have made some investments in technology, and these are elevated costs which have been done because of the investment. So basically, we have increased our processing capacity, we have increased our storage capacity, and so on, to cater to growth. So this is an upfront investment that we have done. That is one. The second is the actuarial cost. As I was mentioning to the previous caller, you might have heard that, is an amount of almost like 21 crores. So based on this, our overall cost structure has increased right now. And of course, the third part, which I also alluded to earlier, about a couple of senior recruitment that we have done. And I wish to confirm that all investment in technology have been done completed. Everything related to lateral leadership hiring is completed. And also, we believe that we will flatten this curve and we will not grow from here. our cost to income will come down, moderate itself in the next 2 quarters. And it is not by only the denominator, but also on account of rationalization of costs, which will happen, and also making sure that there are vendor renegotiations on rentals or IT, non-IT, all kinds of costs. So all services costs, etc. And also we believe that there are a lot of operational efficiencies that we will be bringing in because of this centralization efforts. And all this is like a work in progress. So which is where there is a temporary transitionary period where, there will be a reversal to the curve, but we'll get back to the curve that we want, both on cost and the revenues in due course.
Right. So, sir, this bracket of 52 to 55 would be there for the H2, or we will hover around 58% as cost to income?
We would, for H2, we would come back to about 55%.
Okay. Sir, when we compare our numbers, the September quarter last year with the current, we need to take into account the 71 crore AHS part. So that should be deducted from the operating profit. That is what you articulated and the slide speaks about.
Yeah, compared to the last year, the profit for the quarter, for this quarter is 71 crore. But you are aware that in our mark to market, it is a comparative number with the previous month, where the previous month MTM gets reversed and then the new MTM comes in, right? So it's a function of the rate. So as we speak to you for this quarter and for our current book that we have, which is the AFS book, if the old policy which was allowed by RBI prior to April, where we could show this in P&L was allowed, our profit would have been higher by 71 crores.
A small point, sir, when you were speaking about this gross advantage growing by now lower teens rather than at 18%, if you could give us some color on how the economic activities are currently shaping up, since our focus is more towards the RAM part. So are we seeing stress or lower demand from the verticals where we are focusing? And also on the mid and the large corporate, what is our thought process of increasing the loan book going ahead? I think so now a lot of stress from the corporate part is already out of the system, and every bank is pursuing RAM as their incremental portfolio. So what's the thought process on these two understandings, sir?
So I'll just tell you that we are a 100-year-old bank, and we have relationships that transcend across generations. So obviously, we have had some relationships in this sector, which is the RAM sector, MSME, or even SME sector, who have been with us right from the time we started business, and now the second and third generation are banking with us, and with an increase in business. So there is a lot of loyalty as well as the bank is concerned. That's one. The second is that our overall focus, while it is on RAM, it is for a selected market that we are strong in. So take Karnataka. Karnataka itself, we have over 575 branches out of our 921. But actually, we are in every economic center in 22 states. So which means that, we have not been able to capture the cash flows and, the vendor flows, etc. for all these SMEs and MSMEs and corporates, etc. Which is where we believe that our supply chain program which we are launching will come in handy. So we would definitely, use this strength, one on technology and our physical network of branches, in order to make sure that we actually do this from a overall value chain perspective rather than doing it from a standalone lending or a deposit relationship. The last part is that our overall growth trajectory, I have mentioned to you that, we will be growing our advances book by about 15 to 18%. But the good part is that major portion of this would come from retail and from direct to corporate advances, where the yield will be higher. So as far as the overall economy is concerned, I do not think that there are any major shocks. I think the country is recalibrating itself. The RBI guidance is also quite positive. Unsecured and NBFCs, the story, and we are not in that space. And we believe that we will not have any shocks as far as that is concerned. So our focus is on retail and direct to corporate, and moving away from the large PSU corporate, which were not so yielding, but better than treasury deployment, which was a short-term strategy. Now we are shifting the gears as far as that is concerned, and it takes time for this churn to be completed, but we are actually in the middle of that churn right now.
Thank you for the reply, sir. What do you mean by direct to corporate lending? Means, if you could explain, you have also mentioned the slide that 8 to 10% of the overall advances would be replaced by direct to corporate lending and at higher yield. So if you could explain the terminology, sir.
So just as an example, I'll tell you, we had surplus liquidity in the last year. We have deployed it in the interbank participation certificates, and we have a total of about 4,000 crores that was deployed last year. Now, that is like where we have bought some paper. But having said that, today we will be able to grow the same 4,000 crores by directly lending to the underlying corporate who is part of that paper, rather than having to do it to another bank. So we have stalled that entire 4,000 crores book, and we are not going to grow that book anymore. But we will now start the growth with lending directly to our own new relationship, which are the new labels, new to bank customers on the corporate side and the mid-corporate side. That is what we were talking when we said that we will be doing direct to corporate relationships.
Right, sir. Thank you, and all the best to the team, sir, and my festive greetings for
Thank you so much, yes, to you and your family as well. Thank you.
Thank you, sir. Bye, sir.
Thank you. The next question is from the line of Prabal from Ambit Capital. Please go ahead.
Yes. Am I audible?
Yes, Prabal, good evening.
Good evening, sir, and thank you for the opportunity, and also thank you for giving detailed disclosures in the presentation. So my first question was, in the GNPL breakup that is there in the presentation, the other component seems to be increasing quarter after quarter. What exactly is this other, and what explains the rise?
What? So just a minute, please.
Sure. Meanwhile, should I ask my next question?
Do that. We'll meanwhile pull up the number related to that. Go on.
So we have seen a very sharp drop in slippages at what somewhere 420 crore to 240 crore. What has driven this? Any particular segment, or is it more about our efforts?
Very, very focused efforts. We have a recovery team which has been deployed into action, a collection team, and also making sure that there is senior management focus. At my level, we meet with the restructured team. We have got sparks at every region, and we've got other people at every cluster. So as a result, we get on calls on a fortnightly basis as a cadence. So both the restructured book as well as our overall NPA has come down due to this higher recoveries, and also the last part is that monitoring. The credit monitoring mechanism that we have stepped up now due to our credit transformation process. So that is something which we believe that is yielding immediate results, which will probably reflect in the number going forward also. So as I said, we focus a lot on quality this quarter because of the market conditions, and we believe that we have really done well there. That is a quick.
Others is primarily one account. So others is a mix of.
He's answering the other question which you had, the first question for what?
Others is just something that doesn't fit into any of the standard nomenclature. So it is one or two accounts that have slipped in this particular category. So it is not a consistent kind of reflection of how others is performing. So it's a one LRD account and one in the pharma kind of sector, so which has contributed to this increase.
Why don't we get you the breakup on this later, Prabhat?
Sure, sir. Sir, and the follow-up question to the second part was, how do you see the slippages going ahead? This quarter it was 240 crore. How should we think about it going ahead with all these efforts in place?
So there are two parts to our recoveries which you are aware. One is the recovery from technical write-off. So the technical write-off recovery this quarter was 32 crores. Our target was higher, so there are some recoveries which are under progress, which basically got shifted from Q2 to Q3. So we believe that the technical write-off amount, which is recovery from two accounts, will be much higher than what we have today, and currently it's about 32 crores for this quarter. And the regular NPA recoveries, we have recovered a total of about 148 crores this quarter, as I mentioned to you, and which we believe that will continue the same way. And the reason is that on the restructured where the slippages are coming down, most of them have actually come back to, I would say, normal standard. And the reason being that the moratorium period which was allowed expired, as you are aware, in July and August. So as a result, most of the engagements that we have had with our customer set, the standard accounts conversion is happening, which is reflecting in the overall number, because there was a 100 crore reduction from, or more than 110 crore reduction of the restructured book from 1,160 to 1,050 or so. So that is also the other phenomena which is happening. So slippages target will be about 0.5 for the entire year.
0.5%.
Yeah, for the annualized entire year.
Meaning 2% for the entire year.
No. 0.5% is the annualized for the year.
Okay. And sir, in the balance sheet, my third question was in the balance sheet, your other assets seems to be quite large. Is that limiting your ability to increase CD ratio? That others could be maybe RIDF deposits that you would have kept with Nabard. But is that limiting your ability to increase CD ratio?
We had the RIDF calls which were all on account of the previous years, really, because the previous years, we had this subsectors, somewhere it was not met. The numbers are reducing. The second part is that we have some old RIDF also maturing this next half year to the tune of almost about 2,000 plus crores. And we believe that, with 74% CD ratio, even now we are at 75%. So we believe that there is a lot of headroom. So there is no limiting factor as far as our overall ability to lend and grow the book is concerned.
He has 4,000 crores of liquidity as of that.
Just to add what Shekhar is prompting is that as of September 30th, we had lent to the market, despite this, about 4,000 crores from Treasury, including our non-SLR securities. The reason being that we did not choose to deploy into corporate assets that were low yielding. So we did not want to get committed there. So it was a very conscious call that the bank took.
Got it. And this RIDF of 2,000 crores, when they mature in, say, by March of 2025, would that be accretive to your margins, which is the loan will be better than your RIDF?
As opposed to 4%, we can be deploying.
So there will be a yield opportunity there also, because what we earn on RIDF is much lower, as you are aware.
Got it. Understood. Thank you so much. All the best.
Thank you so much.
Thank you. The next question is from the line of Sushil Choksey from Indus Equity Advisors. Please go ahead.
Congratulations to Bharat. Good evening. Congratulations to Bharat Ka Karnataka Bank on a stable result.
Thank you.
I may be sounding a little critical, but can you explain that growth has not happened between Q1 and Q2 in advances, maybe because we have withdrawn our facilities to PSU and low-yielding corporate advances. But at the same time, you have deployed in IBPC, interbank, and various things, so those rates are reasonable. So why is the NII dropped by 70 crores? First is that. And secondly, how much of CD we have raised in this quarter, or what we have on our books right now?
So, Sushil, just to kind of, clarify there, the IBPC exposures the bank had taken, not in the previous quarter, or it was much ahead, even as much as last year. And because last year we had surplus liquidity in the bank, which we could not find assets and which was deployed. And from then on, as you are aware, IBPCs are normally for 6 months tenure. We've been renewing that. We are not increasing the overall IBPC exposure, which we took up to 4,000, and then we are staying at the same level. That is one. The second part is that the churn that I talked about is that this quarter we have not grown, but then there is, obviously you are aware that in the retail book of 36 months tenure, there is a one-third which gets repaid every year. As a result, on a month-on-month basis, there are repayments. The second is that for gold loans, the tenure is 1 year, which means that it gets repaid over 12 months in terms of EMIs or whatever ways. Despite that, the net accretion of our retail book has been about 1,300 crores for this quarter. We have chosen not to do this because we deployed our excess liquidity into the market through treasury rather than having to get into a corporate asset, which is the PSU, etc., which was all at interest rates of ranging between 6.9 and 6.95, etc., and where we could have got stuck in a market where it is widely expected that the rates will come down. Despite the reset option that we have, there will always be a lag, which is why we took a conscious call. That is one. The second part is that you talked about the CD ratio. The CD ratio part, is comfortable for us, and even going up to 80 is something that is a possibility because liquidity is not an issue. But it's just that we wanted to be very sure on the assets that we deploy and the positioning that we wanted to take for the next, let's say, foreseeable quarters and half years. Which is why the bank took a conscious call not to kind of grow over profitability or quality. That is, I think, a quick summary of what we did.
My question is more pertaining to operating revenue was 4,178 crores in 23, 4,618 in 24. The current year run rate is visible that we should be getting somewhere in the vicinity of 4,600 crores at max.
Yeah.
And the second question is, you would have received all your payments from large corporates on day one, and the deployment in retail and other takes time.
Right.
The strategy change would have costed the bank a little bit for the quarter. That is the general assumption I should take.
What happened, Sushilji, is that we have, you are aware that, when there's some uncertainty in the market as far as the interest rate is concerned, then the bank takes the conservative step, and this is exactly what we have done. Yes, you are right that, our interest income, has come more or less, at the same level or probably 30 crores here or there. And that is because we have remained stable. And our loan yield also we have maintained at the same level. It is again, compared to the previous quarter at 9.5, 9.55. That is something which is the same, and our cost of funds also remains the same. All that we are saying is that there is a conscious strategy basis this, and our overall income on our expenditure now is been stabilizing, and we want to make sure that the same thing remains with the growth, that opportunity that we are sitting on in the next 2 quarters and foreseeably future quarters thereafter, whereby we will be able to increase profitably and also making sure that our deployment is to higher yielding assets, which has been the focus. Our Mr. Girdhar Rajaram, who is our corporate business head, and between Srini, who is our retail business head, assets, they have pipeline, which definitely is very healthy, and we believe that our numbers will get achieved, but more profitably rather than the 6.9 and 7% loans that we were deploying in the past.
My next question is the transformation and aspiration which Karnataka Bank has showcased the world in last 12 to 24 months is a very wonderful experience in terms of what we have rolled out. I'm sure initial cost is borne. When do we see the result of this in this next second half, or we'll see it from next year in terms of 75 to 80% of the target what we are seeing? I'm not saying 100% would be achieved in 6 months or not.
This transformation is a journey. It is not something which is like, start and stop, start and end. Basically what we have done is the following. That one, the bank did not deploy their liquidity to its fullest extent. From a mid-60s CD ratio, we have moved towards 75, and then the 75 can go up to 81. Secondly, the liabilities were not growing. Earlier it was growing at about single digits, and now we have doubled it, and we are growing at double digits and more than the market or equivalent to the market on the liability front. Third, CASA we are maintaining and will continue to grow. As a result, our deployment opportunities are also high. The second is that within the bank, the deployment, as you know, immediately we had done this, which is like, to deploy into short term, immediately yielding assets better than treasury. But I would say the rate differential was hardly some about 50 to 70 bits, but still it was good. But from that level, now we are increasing it to the next level, which is basically where our yield will be more like closer to 9% on those kind of corporate assets, etc., but with same security or not kind of reflecting on anything related to quality, and also getting other income through that. So basically, this is a very conscious strategy. To play this out, it will take the next 2 quarters to stabilize, and then the growth engine whereby quarter on quarter we will see this. So, but the current running rate that we have is about between these two segments, about, let's say, closer to 3,000 odd crores. How do we make that 3,000 to 4,000? How do we make that 4,000 to 6,000 is the next, kind of stage of, I would say, developmental activity which we need to do. Because as we increase coverage teams, as we increase our capacity, which is credit processing capacity, technology capacity, operational capacity, etc., we will be able to do. That is the precise transformation journey that we are undertaking. And we believe that the results will start showing up in the following quarters this year itself. But actually to mature and fully blown, higher run rate bank would happen in the next financial year onwards.
Second thing is, we have technically written a book of about 3,000 crores, including total asset write-off. What kind of recovery are we seeing in current 6 months, and what percentage are we hopeful in next 18 months?
In the last 2 quarters, we did 46 crores and 32 crores. So approximately we have done 78 crores. And we believe that, we would be about, let's say, another 100 odd crores, which will come in for this year also, just the rest of the year. So that means that, we would recover about 170 to 175 crores in all for the year.
What is the pool left as on today in the balance sheet?
3,000 odd crores, I think. But less than, so 3,000 plus crores. 3,000 plus. Fully provided for, almost 80 to 90% provided for. Sorry. I'm being corrected here. So they are saying 100% provided.
Yeah. So we have 3,000 crores and you're hopeful of recovery, what, 40%, 50%?
So we'll step it up now, but the current outlook is that we would recover at least, closer to 175 crores from that book for the year.
Second thing is, global yields might have been...
Please rejoin the queue for further questions.
Thank you.
Thank you. The next question is from the line of Harshvardhan Agarwal from Bandhan AMC. Please go ahead.
Mr. Harshvardhan, good evening.
Good evening, sir. So just on the guidance of slippages, you mentioned 50 basis points. So wanted to check, we are talking about gross slippages or net slippages?
Gross slippages.
So just doing the math, our first half slippage is already 660 crores, which is anyways, even if our book remains where it is more than 50 basis points. So how is that on a gross basis we will have 50 basis points for the full year?
So what has happened is that, there is this restructured assets which we started with 4,500 odd crores, which has come down to about 1,050 crores without related accounts as of now. So obviously, the last residual on that, which is something where these are very granular, kind of loans. So we believe that, as we kind of engage with them, post this moratorium period ending, we believe that, there will be some kind of slippages there. So that is why we have provided for this 0.5 compared to the 0.09 and 11.11% for the first 2 quarters. So we believe that, this 0.5 is conservative, but still, I think, very doable. So that is the first point. The second point is that we have deployed very clearly some teams to focus on this net NPA because of this, new collection head coming in for, again, loans lesser than 50 lakhs, etc., because that requires a lot of collection mechanism to be put in place. So we believe that, that portion will also start kicking in now, because currently the larger tickets are what is being chased by the bank for this recovery, and which is where the recovery is happening both in terms of the technical write-off book as well as the regular book, NPA book. So we believe that within that NPA book, through deployment of this external collection agencies, etc., which will be more applicable to the retail side, we believe that we could see some kind of healthy recoveries there. So that, I think, is a quick commentary on the overall slippages. And
what I just understand is when we talk about gross slippages and when we talk about 50 basis points for the full year guidance, we are taking into account the recoveries or upgrades that we may have during the year. Is that correct?
Yeah, correct. Absolutely. The new even this quarter also, there have been some upgrades, but very minimal. So just to let you know, I'll just tell you the upgrades that have happened for the how much is upgrade for this year? Additions were almost like 200 plus crores that have happened, but then we have also done the reduction through this 329 crores. So the total was 162 crores plus, and technical write-off all put together. So we have the breakup which we can share it with you.
Yeah, got it. So that's my question is answered. Thank you.
Thank you.
Thank you. The next question is from the line of Priyank Chedda from Vallum Capital. Please go ahead.
Yeah. Hi, sir. Congratulations for the speedy quarter. Just again, clarifying on the quarter-on-quarter 30 bps decline in the NIMs is what you mentioned is a 4,000 crore of a book which was excess liquidity which you deployed in the treasury, and because it was a AFS book and you couldn't report that 70 crores of income, otherwise it would have been higher by 70 crores. Is that understanding right?
So let me just clarify that. One is that we had a one-time refund of IT and the interest on that, which was 81 crores for the first quarter, which I had already mentioned during the last earnings call. So that is an opportunity which was one time and which will not happen again. The second part is that the 4,000 crores that I was telling you is that between surplus liquidity and non-SLR liquidity that we had, we have deployed that into treasury yield rather than having to deploy them into corporate assets. And that is a conscious call that the bank took, where even if the treasury yield was a little lesser, but still we would have actually made more as far as the longer term is concerned. The last part is that if we had taken the treasury income for this year, which is the H1, both quarters put together, because MTMs on treasury, as you know, is the latest position. It is not by quarter. So I'm saying it for the H1. Last year we could recognize that into P&L, but had we considered the same accounting policy which is not allowed by RBI anymore, that would have been 71 crores. So that is an addition that we have.
Perfect. That got answered. My question is on, sir, outlook on the fee income part, knowing that you have been building up a team. How should we look over a longer period of time, the fee income part, which is, I think we are almost half to what industry would be in terms of the percentage to the assets income, which is, if you can provide outlook on the fee income and as well as on the retail loans, when we say that we would like to grow the book, any particular segment of the retail which you think is the key focus area that we should think over next 6 to 12 months, where you would grow your book substantially?
So I'll answer that last question first. I think I've already mentioned that before, but on the retail side, there is obviously focus on mortgage, vehicle and education loans, and also gold, which is a shining product for us, where the yield is also good and the growth is also good. We believe that both agri and non-agri gold will also be part of this whole journey on the retail asset side. Now, coming to your first question, which is related to fee to assets. Yes, I agree with you that, fee to income, as a percentage in comparison with many banks, we are very low. We acknowledge that, and which is why we are now putting in place all these products. So the cross-sell penetration, which is very essential, both on the retail side as well as on the corporate side, is something that we want to look at. So for this, we have to put our technology in place. So currently, we do have the third-party income coming from insurance and investment distribution products. But again, with the wealth advisory platform coming in, already we are seeing this going up compared to the last year. In fact, compared to the last year, the number is almost like double of last year, and we are on that track. The second is that there is a cross-sell opportunity which is basically on trade and foreign exchange, and this is something that will materialize in the next following quarters only, where we do not have the infrastructure, product, or related to the knowledge, know-how to be delivered at the branch level. So we have now just kind of structured our corporate finance branches in 5 locations, and also the overseas branches and the nodal branches who can handle foreign exchange businesses. The last is that our regular other income fee-based products like locker, debit card, and broking, etc., are all more or less on track. We are making whatever that we were making the last year, but all that will increase because of these 3 areas, which is distribution products of third-party insurance, investment, broking, and also the trade and forex. So we will definitely see that happening, but that is currently in a build and execution phase.
Perfect. Just last question on the loan book composition. How much would be EBLR linked? How much would be fixed? A broader bifurcation if you can provide. And in case, what happens to the yields on the loans if, say, there is a rate cut coming up in next 6 months by RBI. So how would our loan book yields move?
So great question. About 50% of our book is EBLR linked. There could be some on the retail side also, but overall I'm calling out to say that about 50% would be EBLR plus. Now, as and when there is a rate change, obviously the asset side will be, the repricing first and followed by the liability side. But having said that, because our retail, liabilities, which is forming almost 92% of our overall term deposit and, whatever that we have, but we do not have bulk. So as a result, while there will be a residual, but we can change rates at short notice, and we will be able to match the ALM between the two. So it is not like other banks where there is always a lag between asset repricing and a liability repricing. So that is something that we are confident about this. But having said that, we have anticipated some in terms of the interest rate changes, scenarios, etc. And with our treasury and our advisors on the treasury, we are making the right calls at least so far, and we believe we will be on the right side of those interest rate changes as we go forward.
Perfect. Thank you. Thanks a lot. All the best for the future.
Thank you so much. Thank you.
Thank you. The next question is from the line of Anand Dama from Emkay Global. Please go ahead.
Sir, thank you for the opportunity. So my question is on LCR. You said that you have accepted the recent draft guidelines which actually came from RBI. There, in fact, RBI asked to increase the runoff rate. Have you increased the runoff rate in your LCR calculation, or is it more to do with the recent RBI supervision where they had asked banks or select banks to basically reverse their LCR?
So I'm handing over the call to Raghuram, who is our Chief Risk Officer. While there is this, high quality, loan book, etc., which there is a change, but he will exactly explain how the changes have happened compared to the earlier part of the year when we had done the LCR calculation. But now, on a conservative basis, we are sticking to the draft guidelines, although we are not compelled to do that. So that's something which Raghuram will explain.
See, we currently there are changes for the top line, that is HQLA, was also there was a change in from the way the level 1 assets were being taken.
from the book value to the market value. Second point was the run-off factor changes based on the type of digitalization availability. That was the point. We agree there are certain gray areas still in the RBI draft circular. It is being addressed. Definitely there is a jump in the run-off factors for certain kind of classes. So that is why there is a downward trend in the LCR. It's a phenomenon across time.
So again, we are awaiting clarity because we've asked these questions to RBI also. But having said that, this is being represented at multiple levels, including IBA. But this is not a Karnataka Bank phenomenon. This is across the banking industry where the changes are underway. But we believe that if we test the waters on this and report, how would we be? And we are still at 143%, which is a very comfortable state, and which is what we wanted to report this quarter.
Sure. So for the investors or the analysts, basically reporting this kind of LCR is fine, but the RBI, when basically the reporting goes, will be a relatively higher LCR because then you will not expect this happen. Is that the understanding correct?
Yeah, correct.
Correct. The second question is on your loan growth, where you have reduced down your growth guidance from about 18-20% to 15%. What will be the share of retail loans as per your new classification that you have in the presentation? And what will be
our mix will remain the same, 50% from retail, and the balance 50% will come from direct to corporate, as I explained earlier to other callers. Combination of various segments within that. But again, this is a conscious transitional strategy. It is not something where the bank had slowed down the engine or anything. Because of the market conditions and the fact that we did not want to get stuck on the wrong side, we believe that it is better to kind of deploy them back into treasury, which is how we have not grown our asset book. But we will come back. The engines that are building up now, which is the retail and the direct to corporate strategies, will start kicking in, and we believe that our asset acquisition will be at a higher yield compared to before. And
almost 40%.
For just to confirm, retail plus mid-market MSME, etc., is about 60% right now on the run rate, and the balance 40% is coming from large corporates and other mid-sized corporates.
And sir, your ROA guidance is about 1.2 to 1.4. Whether there is a revision, downward revision in that as well, or like that?
No, we would stick to that guidance. This is a temporary blip because of this quarter strategy. We would come back to our 1.2 range very soon.
Sure. And sir, the next slippages, I think there was always confusion around the gross slippages and so on. I think what you were referring was the next slippage number. So gross slippages minus the recoveries and upgrades, right? You are not taking off write-off from that slippage number of about 0.5% that you were talking about.
No, sorry, your question is not clear. Are you asking us a question that this gross slippages does not include technical write-off? Is that a question or?
What I'm asking. So you said that you gave a guidance of about 0.5% slippages.
Correct.
And then I think Harsh asked you that basically means that gross slippages minus recoveries minus upgrades. So you said that that also you need to reduce the write-off from that.
Correct.
I believe next slippages typically would be gross slippages minus the recoveries and upgrades, and not the write-off. So what will be that guidance?
Yeah, correct. We confirm that.
So this 0.5% is gross slippages minus recoveries and upgrades, right?
Addition to NPA.
Abhishek is our CFO. He is answering this question.
Yeah, please.
Currently, it is the actual addition to NPA and the reduction and the recoveries also.
For the
it is offline. I think basically the normal culture that we use and I think what you are using is slightly different.
We can align ourselves then. Yes.
I can give you some additional information also.
Perfect. Thank you.
All right. Good. Then back to you.
Thank you. Ladies and gentlemen, due to time constraint, we have reached the end of our Q&A session. I would now like to hand the conference over to Mr. Sri Krishnan sir for the closing comments.
So, on behalf of Karnataka Bank, the entire management team and the board, I wish to thank you, investors, for your support, all the analysts for your questions and guidance. There has been a significant contribution and suggestions that we have received in the past on the disclosure and the changes to the presentations, etc. We have taken all that into consideration in the last couple of quarters. So every quarter we are only improving on the overall delivery. Thank you very much for the support, and we see that the future is good as far as the upcoming quarters are concerned. Once again, thank you all, and best wishes for the festive season.
Thank you. On behalf of Karnataka Bank, that concludes this conference. Thank you for joining us. You may now disconnect your line.